Hey everyone, this is Joe Grundy from the Alliance. I'm very proud to announce tonight that we have Tina Pittman, CPA with Your Accountant, on the line to help us get going with practice finances and proactive tax planning. I wanted to let you know a couple things up front. First, the DPC Alliance does not profit from any of our vendor partners, of which Your Accountant is one. Tina was actually recommended to us by several DPC Alliance members as a truly knowledgeable expert around proactive tax planning, which is why we wanted to bring your attention. And with that, I'm going to turn it over to Tina. Tina, it's all yours.
I want to thank you, Joe, and the board for having me share what I do and help DPC entrepreneurs save on taxes. And actually, when you catch on, it's like having another revenue stream in your business. I know taxes is tough subject and sometimes can get boring, and possibly you just want to hand it over to someone and just have them take care of it. But it's important that entrepreneurs understand who, what, when, so they can help be creative in what I'm about to talk about. You will find there's opportunities for things to be implemented into your business. So with your permission, let's get started. Sound good? I have been doing what I love for the last 30 years. I am a CPA and a certified tax coach. I specialize in proactive tax planning, resolution, and CFO services. Now, instead of going through, you can read the screen on a little bit about my background, but you probably want to know a little bit more about why I am doing what I am doing. It really started about the age of 12. I was, if you can imagine being on a dairy farm, it was some tough times back then. I was about 12 years old. We were hit by 2 recessions, drought, and bad weather. When I was growing up, we played with what we had. We had cats, dogs, and even calves if we wanted to play with them. My parents would not speak of finances in the house. Later on in life, I found out that they had taken a $20,000 loan to buy a silo. Back then, we were hit by bad weather, droughts. So the crops did not make it, and the silo had no value to them. They couldn't feed the cows, so the silo became a financial burden to them. So my parents were actually forced to sell their farm. And I think about it today, if only I knew what I know today back then, they could be rich from the sale of the farm. So when they sold it, I guess I became obsessed with educating myself on finances. I kept taking classes as I thought I didn't know enough. I kept taking more, got more credentials. And you see that I have multiple credentials. So that's the explanation to that. And back then, whenever I was going through school, I also worked full time with a job and went to school. It was hard work, but eventually it paid off and it just clicked. And I knew I had to teach other business owners so they didn't do the same mistakes that I grew up with. And of course, whenever I was younger, I tried businesses and it was like, it wasn't any fun. So let's get started. Most firms do your taxes and they see you next year. It's very transactional relationship, and they really don't work with your goals and interests. So when I became a certified tax coach, that's when I realized there is more to it than just preparing the return. So for today's agenda, it's titled Shrewd Tax Planning for the DPC Entrepreneur. We're going to talk about what it means to be proactive in reducing your business taxes. We know taxes can be unfair and sometimes maybe the largest expense that you have. So I will try to do my best to keep your anxiety down. And I know some may be actively avoiding taxes. So the second area they're going to talk about is why you should rethink your business entity. And the third one is what strategy options do you have? I'm going to show you tonight probably the lowest fruit on the tree to get started and implement right away. So there's lots of opportunities and there's just not enough time to go over. There's hundreds of strategies, but I'll go over a few of these strategies. So let's get started. We are used to having, I'm going to go a little bit over the profession and how it's transforming. It's transforming just like DPC industry, healthcare is. There are traditional tax preparers or financial people out there. We have the bookkeepers, financial planner, tax attorney, enrolled agent, and the traditional CPAs. And again, we're much like the DPC industry. We are making waves and making changes. So as I mentioned, I'm a certified tax coach. So we are changing what the tax industry is doing. We are the tax people to go to. You have to be either a CPA or an enrolled agent to have the certified tax coach credentials. There's no comparison to tax planning or reduction than from one of those coaches. We are innovative professionals, just as the DPC positions are. You're very innovative. So what I do is I actually start off where your tax preparer leaves off. And I scour the tax codes and I proactively plan all year. So what does proactive tax planning mean? Because I get this strange look when they say proactive tax planning. What in the world does that mean? So serving to prepare for, intervene in, or control an expected occurrence or situation. So proactively planning to save taxes. With tax planning, it means you don't just look at your history. Most owners rely on information, and information serves markets. It tells you about your services, your customers, and information to make money and information to keep money. You rely on your accountant for some of the most important information, but does your accountant actually do? What do they actually do with that information? At tax time, your books tell your accountant how much tax you owe. And I'm just giving you a little background on the evolution of tax planning. At tax time, you scramble for more receipts and you try to look for more deductions so that you can bring that tax liability down. Most accountants record the history you give them. They compile monthly, quarterly, or annual financial reports. And then tax time, they put the right numbers in the right boxes in the right forms and then file them by the deadline. I think that's pretty much how I can describe tax time for most people. So is that really what you want? Probably not. Not once you're done with listening to some of these strategies. So let's make one thing clear. Tax planning is not projecting your business income and then estimating your tax payment. That's not planning. Bonus depreciation, if you've heard of that, that's not planning. That's just a standard deduction that you get. Retirement plan contributions, that's still not tax planning. So we don't jump in and quickly make a diagnosis of your books, and you can relate to that you don't do a quick diagnosis with your patients. So we treat your books and your taxes the same way. I hook up the machines just like you do and give you an analysis of your options. I personally work with you. I prepare the plan in which you can pick one or several options to implement. You need concepts and strategies that leave more on the bottom line without raising red flags or straying into the gray areas. So, things to question. Things I'm going to go over is how you organized your business right. There are new tax rules that makes you question what type of entity you are. Questions you want to ask if you have the right benefits for yourself and your employees. And it depends on the type of structure. Do you have the right retirement plan? Are you taking deductions that are legit? The credits, the loophole strategies that the tax code offers. So I love this statement here. Warren Buffett says everybody talks about tax breaks, but no one talks about how to get them. Well, we are changing that. We are talking about them, and we keep moving on and get people what they deserve. Being an entrepreneur, you have so many things to consider. You've got your bookkeeping, payroll, taxes, financial statements. You have many questions on running your business with your advisor. So it creates a lot of stress for you. So I'm hopefully going to take the tax part, at least, out of your business. So think about it. In today's world, if you add up what federal tax, state, and maybe you have a local tax that you need to pay, it could be add up to 40% in combined taxes. That is a lot. So if you make $100,000 in profit, you're paying $40,000 out in taxes. That's a lot. That's stressful. So I'm going to review the ordinary earning tax cycle. You first earn your money, and this is what's taking place nowadays, and we want to change that. You're going to pay your taxes and then spend what's left over. So if you're like me, I don't like that philosophy, so I want to change that. Let's call the next cycle smart earning tax cycle. This is how it works. You earn the money first, you spend and save the money, and you pay tax on what's left over. A little bit different concept. So how many people like that idea? I'm sure most everybody does. So here's what everybody's been waiting for: how to start using the IRS tax code to your advantage. As you become more strategic in operating your business, it's highly likely that your bottom line will increase, or you may as well go home. Why bother? But wait, that also means that your taxes will increase. And that becomes a problem that many do not know how to solve it, but I do. Let's just go through a few simple strategies. In front of you, let me get all these lines up here on the screen. Oops, went too far. Is a short list of opportunities to take advantage of. We will go over only a few of these because we just don't have a whole lot of time to go over the hundreds of strategies out there. So the ones I'm going to go over can be implemented inexpensively with the right compliance setup. And then these are strategies that you can use over and over each year. There are, like I said, hundreds of strategies. The first strategy we're going to go over is a major one. It's minimizing your taxes by income shifting. You may or may not know about this option, but in a nutshell, income shifting works based on the tax system because there's tax brackets that we can move money over to a lower income tax bracket, and you can pay tax on the lower income. That's part of a strategy. So we move income from a place that's a higher tax rate to a lower tax rate. So these, when using this strategy, you want to consider the years where you are going to have a lower income tax rate. So that's one area you look at. But at the same time, you want to look at what your current situation is. You forward think about the taxes, and then you also current state of tax bracket. So for example, you may have multiple revenue streams. That's one thing that we will take a look at. You have revenue streams for prescriptions, lab work, physician services, and that's your monthly membership fee. You possibly have specialized testing income, expert witness, speaking engagements, writing specialty services. Maybe you have a side hustle or a physician's assistant doing add-on services that you would normally pay extra for. So those are the different revenue streams that I am talking about. We would review, along with the income shifting, you may have established maybe one entity. That opens up the door to multiple entities because the entities are taxed differently. So it's a hidden secret to strategize and start thinking that way, shifting your revenue streams. So at this point, I would like you to at least think of 3 revenue streams that you have potential for that could be shifted into a lower bracket, an entity with a lower tax rate. That's what I meant to say. So another tax strategy is income shifting with family and to other people. Family is your first go-to option. Hiring your children and grandkids can be a great way to cut taxes on income because they pay less taxes. You and your spouse may be at a 37% rate, but your children may be at a 0% rate. So to be in compliance, to take advantage of the zero tax, you can pay them up to $12,200 in 2019 and pay zero tax on that. The great thing about that is it's because your children will file their own tax return, and there is a standard deduction of that amount. So their income would be less the standard deduction, and taxable income would be zero. But when you go above the $12,200 in wages, the next tax bracket is at a 10%. They can earn $9,700. So 10% is much lower tax rate than what you would be paying on your tax return. So there is some criteria that you need to keep in mind when you do hire your kids. It's just not just hire them. Let me pull up all this. Let's hire them and deduct that. So your child must be at least 7 years old, and you must have a job description written. So once you establish those, you establish a reasonable wage. So what I mean as reasonable wage is, what would you pay someone else to do the service that they are providing? For example, if you have a 12-year-old son who cuts grass for your rental properties or your office, you would pay him what you would pay a landscaping service. If you have another example is a 15-year-old, helps keep your books, pay him a little bit less than a bookkeeping service might charge. They aren't as experienced as a bookkeeper. So if you would write up a job description, and just it would be just like any other employee at your office. So I did put on the screen the link because I know there's been questions at the summit that I was at. What does the Department of Labor consider if you have to deal with the child labor laws? And according to the Department of Labor, and that exact link and this is what it says. The minimum age requirements do not apply to minors employed by their parents or by a person acting as their guardian. An exception to this occurs in some other industries that are listed on the site. So you're really good to go. If you've got the reasonable wage, if you've got a job description, and one thing you want to make sure that you do cut them a check, put it in their account. The account can be a Section 529 college saving plan. You can be in a regular account. You can put it in a custodial account and control it until they're 21. So what's the purpose of paying them and hiring them? Let's say your teenage daughter wants to spend 2 weeks at a horse camp. So what she would do would earn the money herself and pay tax on it if she's over the wage bracket of 0%. And she can pay the camp with after-tax dollars. So you get the deduction and she gets to pay for her camp. And she gets to earn the money so she can pay for it. So I think that's a good deal. So keep in mind, if you do hire your child in your unincorporated business, you don't have to withhold Social Security until they turn 18. You would still issue them a W-2, but no Social Security tax. So that's really awesome. Less taxes you have to pay. So here's another strategy, a great bonus to paying your children. When you hire your kids to work in your business, you are qualified to make a Roth IRA. Now you know that the Roth IRA earns tax-free income, right? So let's say you contribute $2,000 per year, and this is up to only age 17 for your child. By the time your kid reaches retirement, they will have over $2 million in their tax-free account. So what you actually invested was about $20,000. So I say that is a pretty good deal for when your child gets older and needs to retire. And just think you save taxes on that $20,000 as well. So this is the time we'll pause. Is there any questions in regards to income shifting and paying your children?
Hey, Tina, this is Joe. Can you hear me?
Yes.
Perfect. So we actually did have a number of questions, both about income shifting and then more generally. So starting with the general first, the frequent concern is, what if you spend too much? What are you on the hook for in terms of penalties and you don't have enough money to pay the taxes you owe?
If you spent too much? Can you read that question again?
Yeah. So what happens if your business spends too much and you don't have the capital to pay the taxes that are owed?
You have the option of doing an installment agreement. So that can be completed at the time the tax return is prepared. And you would take a look at what you can afford as installment payments. The penalties are like about 25%. They're never over 25%.
So the next question is, you mentioned that your work as a CTC starts where CPAs leave off. I know that you are a CPA and a CTC, but would someone need to hire a CPA if they were in contracting and working with a CTC?
Yes, I work with other CPAs, so you can still utilize, if you really love your CPA, you would still utilize them to prepare your return. And I would just do the tax plan.
So what would be a good percentage of revenue to save for a normal DPC practice, and understanding that, every DPC practice is different?
Yeah, if you are more on the startup end, I would save at least 25%. But if you're in the six-figure profiting, you would want to save 40%. And that depends on if you have local taxes that you need to pay too. And it also depends on what type of entity you are. I'm talking in regards to a sole proprietor.
Perfect. The next question is actually more specific to tax shifting. So you mentioned that, deferring taxes in terms of the payments out to family members, such as a child. But so can you expand on what it would look like to pay into a 529 plan?
Yeah, what you would do is set up an account at a college. You would put it in that child's name. You would pay the wages to the child, and it would still be W-2 income, and then deposit that money into the college fund that you have set up.
Perfect. And so final question on the tax shifting front, and then we can go going with the content again. So you avoid taxes on your business income by 0% on what you pay for your children. Can you just clarify that perspective a little bit for us?
Yeah. If you are a sole proprietor, you would have your business on your tax return and you would be deducting your child's wages. So you on your own as a DP physician would not be paying taxes on what you pay your child. So the child would also file a tax return and they get a standard deduction of $12,200 for 2019. And so their taxable income is zero. So no tax would be paid there either.
Okay, thank you so much. I think that's all the questions we have for this segment, so we should keep moving forward.
Okay. Before I forget, I popped this slide in because of the income shifting. If you have formed an S corporation, you have one problem with the documentation for your own personal wage that you pay for yourself. So what has happened with the new tax law? Usually it used to be the IRS had to prove that you did not pay yourself enough. But now the new rule is you have to have documentation that your salary you pay yourself was enough. So this is still an income shifting type of strategy, the S corporation, because what happens is you profit, let's say 100,000 to keep it simple, and then you pay yourself a salary of 20,000. So because you're paying yourself only 20,000, we know that's pretty much not a reasonable wage. You're not going to pay yourself 20,000. So because of the taxes that are, the Social Security tax is not paid on the 80,000, the IRS will go after you and redetermine your salary, and then you'll owe taxes for that year that you did that. It used to be, before the new tax laws, the sole proprietorship were the ones that got a lot of audits. Now the IRS is starting to shift over to the S corporation for more of their audits. So you need to be ready to have documentation of your reasonable wage calculation. On the screen now is kind of a sample. There are documentations, additional research to prove to the IRS if you were in an audited case that withstand the IRS audits. So just so that you know that, if you are currently an S corporation and you do not have documentation for your wage, reach out to me because I can do just that part for you. One of the process in that is a survey that you would complete, and it would include all your tasks that you do, administrative, clerical, client services, all that would be taken into account. And that's a little bit confusing. Not sure if the DPC doctors understand the reasonable salary or not. So this is a time to pause if there's any questions on that.
So we did actually have one question. What is the minimum salary you could, quote unquote, get away with for a DPC practice with 600 patients?
It depends on your area. These surveys that we do it by your area. For example, I am in a county that has a lower wage versus Washington, D.C. would be a higher earner, just because the cost of living is higher. So it just depends on where you live. I know that wasn't the answer you wanted, but
No, it's an accurate answer though.
it's no straight answer without doing the research.
Yeah, of course. So another question about the S corp. S corp here, my CPA told us that $100,000 was a reasonable wage for a full panel DPC. Thoughts? And we get back to that same question about geographic trends.
I would think a reasonable wage is probably higher than that. Usually physicians, regular physicians, are making 150 to 200,000. And that's what I've seen in the market.
Yeah. Next question. Any experience with DPCs and audits regarding the reasonable compensation documentation? For a 600 patient panel in DPC, that is approximately 25% of a typical insurance-based panel. You're getting a lot of traction on these questions.
Yeah, I personally have not done the audit, but my team is national that will back up the reasonable compensation survey that is prepared. My software provider backs it up, and they are there for the audit.
Gotcha. I don't see
And they do win.
And they do win. That's an important caveat there. No other additional questions at this time, so I think we can keep rolling.
Okay. This is a time to think about, with the new tax laws, time to think about restructuring your business entity. And the reason why I bring this up is because if you heard about the 20% additional deduction that you get. So if you're profitable in your business, it could be worth 20% deduction. So for example, if you made $50,000, you would not pay $10,000 of your profits. So 50,000 profit less 10,000 is the deduction. That's a nice deduction. So you only pay on 40,000 of your profits. So the reason why I bring that up is because there are different, and I'm sure that DPC physicians have heard of all these types of entities. But if you are in a 25% tax bracket, being an S corporation, it flows through to your personal tax returns. The C corporation has a flat rate instead of a tiered rate of 21%. So it would make sense to start thinking about restructuring your entity. And this is where the revenue streams would come into play. So you can start up a second company. That would be one option to, and I must say at this point, the second company needs to be bona fide. So what we would make sure that makes sense. It was withhold the reason why that second entity was established. And the best part of it is when you start planning, getting creative with your revenues and push it over to the C Corp. Later on, I will talk about how you can lose that 20% deduction just because of your income. I think that was all I needed to say on that one. I'm not sure if I said enough or explained it enough. So this is a good time for questions on that 20% deduction.
So we don't have any questions about the 20% deduction yet, but that might
Okay.
be because of the rather significant lag we're getting between the recording and the
Okay.
presentation on Facebook Live. So we can keep going, and then I'll feed them to you as they come in.
Okay. Yeah, we're going to talk about it a little bit more. So examples of how the 20% deduction can be eliminated on your return. Not everybody can take that extra 20%, and you must have a profit. So if you have a loss, you don't have that 20% deduction. So I'm going to give 3 examples, scenarios on how this impacts you. So the first example is where you're going to assume the taxpayer is single and owns a sole proprietorship. He has a net income of $200,000 from a non-personal service company and $150,000 taxable income. So the deduction would be a straight $40,000. In the second scenario, you don't need to. I just want to make sure you don't need to read it. I'm just going to do the summary because I know it's hard to read the information while I'm trying to talk. So it is in your handouts and you'll be able to see it later if you're a little bit confused. So the second example, we're going to assume the taxpayer is an S corporation with no wages. He has a net income of $200,000 from a non-personal service company and a taxable income of $160,000. And then he has $100,000 on adjusted assets. So now you're starting to get into where the 20% deduction is going to be phased out. So in this scenario, the 20% deduction amounts to $36,025. And the third case example. So it's the same facts in number 2 example, except there is a service business with $50,000 of wages. As taxable income goes over the threshold, the exclusion of the qualified business and income and wages are phased. So the 20% deduction would amount to $23,750. So you can see in this example, whereas your income rises, you need to consider whether you're going to miss out on some of that 20% deduction. And that's where you end up forming a second entity and start to tax plan so that 20% does not get eliminated. Because that could be a really substantial savings on a tax return. And I've seen some high earners really make out they had better tax returns in 2018 than they had in other years. So it's really a good planning opportunity. So I went a little bit quick on those, but do you have any questions, Joe, from your audience?
We do. So one of the participants asked, I believe there's a phase out on the 20% QBI based on salary, right? So can you just expand upon that a little bit?
Really, the calculation is really difficult. You can't do it by hand. You really have to have software to do it. Your W-2 income does not I'm trying to think of the phase out number. It's over 200,000. I'm drawing a blank on it right now. But if you have wages of that amount, it is not included in the profits of that business. So when you go over earning a certain amount of money, you will not get all that 20% deduction. I'm not sure if I'm explaining that very well. So the higher your earnings are, the less you get. And the threshold begins at 160,000.
Gotcha. So I think that hopefully gives enough food for thought for that question. And we could probably keep going.
It's a complex formula.
Actually, I did have one more question come in relatedly. So we quote unquote split up our company into multiple companies? Is it still my income, correct?
Correct. Except for a Schedule or a C corporation where they pay their own tax. That entity pays its own tax. And the benefit of the C corporation is, since it does not pass through to your personal return, it does not get counted in for the threshold of earnings for that 20% deduction.
Awesome. Let's keep going.
Okay. So on the screen, there's an example of how an entrepreneur thinks outside of the box. If you decide to purchase your building, and you will most likely want to set up a separate entity to hold the property cost, you would pay yourself rent. You will not want to charge much over the fair market value of rent in your area. You might want to have other tenants. So sometimes you may not charge enough rent to cover all your expenses. So you may have a loss. So this strategy, this example is where we went in, and since the rental had losses, those losses were accounted for, were deducted from the income from your DPC practice. So instead of, sometimes you have losses that you can't use, but in this case, in this rental case, there's a losses that you can use up to 25,000 without having to suspend those losses. So this is a case where this person freed up their losses that they were carrying forward, and we got them additional tax refund because of the way it was set up. Questions on rentals?
So no questions yet, but if we get any feed through over the next minute or so, I'll pass them your way during the next question period.
So this one is more not known. It is what we call an Augusta. Actually, it's called Augusta loophole. There is a loophole in the tax code where if you rent, so what we do is establish your home as an administrative home office. It's not the same thing as the home office deduction that is really commonly used, where you use one room in your home. So what happens is 14 days out of the year, you can hold your board meetings at your house and pay yourself rent. So up to 14 days, and they must not be consecutive days, is you pay yourself rent and you deduct it on your business return. So it's like if you pay rent of $10,000, you would deduct it and not pay income taxes on it. Did you have any questions at this time? I forgot to insert a question slide to pause at this one.
Not that I have come in as of yet, so we can keep going. Okay. I suspect that we may have a backlog of questions come in as we keep moving forward towards the end of the content, though.
Yeah, I have one more that is not a simple strategy, but I wanted to throw it out there. It is the basics of this strategy would be to, if you owe $50,000 in taxes, you can actually take that tax money and put it into a solar company. And then you would have that deduction. It would be like investing in another company, but it's specifically solar energy. You would not be paying that tax liability then to the IRS, but be an investor in the company. And the advantage of this is you actually it takes about 7 years to get your money back from the company in profits. So then you got the benefit of having that write-off the first year, and then over 7 years, you'll earn that $50,000 back. So that's really like kind of like free money. You think about it. So this one's really complex, and I have an attorney that specializes in that, and it is not a scam. I don't. As a certified tax, we still have regulations to uphold to, so it's not one of those scams. There's an actual attorney that specializes in that. So if you ever want to divert your funds somewhere else instead of paying taxes, this is an opportunity to do so. And it can only be done with a solar company, a specific solar company that has the documentation and is authorized to do so. Another for questions?
Yeah, so we actually did have a number of questions come in about the Augusta loophole. So first, and probably most importantly, what is the documentation that's required to kind of take advantage of the Augusta loophole?
Yeah, well, you still have to show it on your return, but there is a section, and I don't have that section with me. I actually left it at the office. I didn't bring it with me, but there is a tax code that you would have to put on that tax return for that. Can actually get it to you later.
Sounds good. And just for the members on the phone, if you want to contact Tina, I shared this in the chat.
Yeah.
Okay. Your accountant is a vendor partner of the DPC Alliance. Parentheses, we do not profit from any of our vendor relationships nor sell data. But if you log into your member account on dpcalliance.org, it will direct you into how to contact Tina directly. So with that being said, how do you calculate a reasonable rent for the Augusta strategy? Rent for 14 days, non-consecutive seems tricky.
That's where we would look at your area. We would call like your hotels and see how much a room would be. And a large room, because you're going to be renting out your whole house. And one thing want to keep in mind if your entity is set up as an LLC or any of those corporations, you should be having board meetings on a regular basis. So I just wanted to add that note to remind people, because that's something that a lot of business owners forget to do, is hold board meetings and actually write out minutes. So we would check with the hotels and other area within your areas to see what the fair market value is.
So final question, I think it's more of a reframing around the Augusta loophole. So similar to Airbnb, you would rent a room in your house to your company to hold meetings. Your company would pay the normal rent cost for your area.
Right. Right. And you can rent out your whole house. You don't even need just one room. So if you have a couple of rooms and you and your wife could be the board members and hold your meeting and write down minutes to that meeting. And yes, you would use whatever is in the same zip code as far as renting for a day, a conference room.
That makes a lot of sense. So I think that we mostly addressed the questions on the Augusta loophole. No questions on the solar investment loopholes, other than an observation that Elon Musk must love that particular loophole in the tax code. So I think we can keep rolling.
Okay. Well, I'm done with the strategies. So just wanted to brief on, you have a lot of areas to consider when doing tax planning, and that's why I am in the center circle. So that's what I manage, is all the different types of plannings that are out there. We do it under one roof. So I have a slew of family members that are financial advisors, specialize in certain areas of their specialties. They specialize in the certain areas of the tax code. So we do look out for not just the current year of tax planning, but we look out for the future tax planning as well. And again, I want to mention that you can still keep your CPA who prepares a return. The tax plan is separate from the tax return. And just a summary slide of some takeaways. Hopefully you've learned something, got some strategy that you might consider implementing right away. And keep in mind that we do have documentation to each of the strategies that we use. The tax code goes along in with the tax plan. And that screen is my contact information that they can reach me. And they can actually schedule online too if they want to schedule a call. I do 30-minute pre-tax discovery to see if a tax plan can benefit your business. And the DPC does have a discount. So I think you had put it somewhere.
Yep. So it is available in the chat as well as on the member profiles on dpcalliance.org. Yeah. So with that, Tina, thank you so much for your time. This has genuinely been incredibly informative. I suspect that others have found it as well. I mean, just the information you provide on the loopholes and how to structure everything has been incredibly helpful. Yep. And as a reminder to our members on the line, all the Facebook Live videos are viewable after the fact. They are recorded. They're posted on Facebook under the DPC Alliance page, and then I'm also going to put them out on dpcalliance.org. So Thank you all, and then have a wonderful evening. Thank you, Tina.
Thank you, Joe. Have a good one.